Welcome to an introduction to accounting, brought to you by Parkbench Tutors. In this little podcast, we are going to continue our look at ratios. And we're going to look at liquidity ratios, and there will be two ratios, the current ratio and the acid test ratio. There are two liquidity ratios then that are important for BTEC studies. So, first of all, what are we looking at when we look at liquidity ratios? What we're looking at is basically how solvent a business really is. Can it pay off what it owes with what it's got, if you like? Can all the liabilities be paid off in the next 12 months? So we do this by measuring two things. We make an assessment based on the current ratio and the acid test ratio. The current ratio is simply the current assets to the current liabilities. Current assets are those assets that in the normal course of business would be turned to cash in the next 12 months, which includes cash, of course, and it includes selling all the inventory, because we would expect that to be sold off in 12 months. If we didn't sell our inventory off in 12 months, there would be something wrong. And it would also include collecting all the money that we are owed, all the trade receivables. The current liabilities means all the payments that are going to come due within the next 12 months. And we can get those figures from the balance sheet. So here's a typical balance sheet for a clothing design firm, Tropical Designs, and we can see that the two figures here that we're interested in are the figures for total current assets, and the only current liabilities here are trade payables. So the figures are 34,350 and 1950. So our current ratio, current assets over current liabilities, 34,350 over 1950 gives us 17.61. Well, that ratio tells us that the liabilities could be paid off several times over, so there would be no problem there. There would of course be the question of whether that's a good use of cash for the business. Okay, now let's look at it 1 year later, where the total current assets are now 16,300 and the total of the liabilities 9,800. So we look at the current ratio again, current assets over current liabilities, 16,300 over 9,800, 1.66. Right, there are still sufficient current assets to meet current liabilities, although obviously the margin of comfort is not as great now, and this could mean that we've made possible better use of cash over the last year. In order to actually determine that, you might start looking at how the non-current assets have altered between the 2 years, but you would also want to look at what the sales were between the 2 years and what the profit levels were. Right, so the balance sheet for Tropical Designs here then, in a different situation, we have 9,800 for the current assets and 9,600 for the payables, a difference of only 200. In this case, current assets over current liabilities, the ratio is only 1.02. This looks as if it's a problem. In other words, the business is only just able to meet liabilities. Over the course of the next year, there are several potential problems. A problem of cash flow, because there's only a small amount of ready cash, and the fact that if you look at the years, there's been rising trade payables compared to the previous year. There's been investment in assets, but a reduction in the profit. We'd rather hope the opposite would happen if we invest in assets. So, if it was a company and you were an investor, well, what is an investor looking for? In general, it's accepted that you probably look for a ratio of 2 to 1 or better, but not too high. Why? Because if the ratio was near to 1 or below 1, there would be a disincentive. This could be a company that is in trouble. If it's less than 1, then the business, of course, could be well on its way to bankruptcy. The acid test is current assets minus inventory divided by current liabilities. In the UK, you might note we use the term stock instead of inventory, but by and large you will find most countries will use the term inventory. So, why does this ratio exclude inventory? Well, there are a number of reasons. The stock could actually become worth a lot less in the future if you're suddenly faced with the prospect of having computer equipment on your hands where new computers have been developed. Then what you have as inventory could in fact be obsolete. Similarly, if you have invested heavily in clothing, you suddenly might find that clothing is out of fashion, it's less popular, so it's not going to sell. And of course inventory could be damaged or it's even stolen, in which case it has to be written off as a value. You also might note that when a company goes into administration, stock loses value very, very quickly, and it can never be sold at its original sale price. So here's the balance sheet for a hardware company, Miranda Hardware, and so let's apply the acid test to that. We have inventory of 6,500, total current assets 21,900, trade payables 8,400. So our current ratio, current assets over current liabilities, 21,900 over 8,400 gives an answer of 2.60. An acid test, current assets minus inventory divided by current liabilities, gives us an answer of 1.83. Still close to the 2 to 1, so it's not too bad. Now let's look at another year. This is a 1 year on situation. Inventory 12,600, total current assets 25,200, trade payables 14,000. Now we look at this current ratio, current assets divided by current liabilities, 25,200 divided by 14,000, 1.8. The acid test, current assets minus inventory divided by current liabilities, 25,200 minus 12,600 divided by 14,000 gives 0.90. Ooh, that's low. So how do those figures compare with the previous results? Both those ratios are falling. So both of those could be danger signs. The ideal ratio is believed to be around 2 to 1 for the acid test. So, how might this affect us if we were considering investing in Miranda Hardware? Well, I think we'd probably say no. That ends our podcast on liquidity ratios, brought to you by Parkbench Tutors, narrated by David Hopcroft. For further information, you may visit parkbenchtutors.com, or you can find Parkbench Tutors on Facebook. Thank you for watching and for listening.